Hello friends. In this video, we will discuss the key ingredients required to build a successful long-term investment portfolio. Let's get started. We will go over how to invest regularly, building a well-balanced and diversified portfolio, how to research investment opportunities, impact of taxes and fees that needs to be considered, and also talk a little bit about the right mindset we should develop to stay on track. We will discuss these topics at a high level in this video and go deeper into each one in future videos. In order to build a massive portfolio of assets over the long term, it is critical to start by investing small sums of money regularly. A set amount can be determined by you and put aside, say, on a monthly or weekly basis. The best approach to take is to automate the deposit into your investment account. Also, we should be committed to do this consistently over several years to enjoy the full benefits of compounding returns. To determine how much you can start investing periodically, it is important to assess your life circumstances and understand how much disposable income you have left over after all your expenses. This is critical as investing is risky and we should never invest more than what we can afford to lose. Another important thing to consider here is to not rely on investing as a wealth creation tool in the early years, but rather focus on building other sources of income that will help us increase our periodic contributions over the years. The next topic we will discuss is diversification, which is the science of creating a well-balanced portfolio that is focused on avoiding over-concentration on just one or two asset classes, countries, etc. To create such a balance, it is important to spread the investments across several countries, purchase a mix of stocks across small, medium, and large companies, and also buy into these assets slowly over time instead of putting large sums into them at one go. This is usually referred to as dollar cost averaging, and we will discuss this in more detail in the next videos. Apart from region, size, and time diversification, it is important to own a bouquet of assets of varied characteristics like value stocks, growth stocks, income stocks, exchange traded funds, options, commodities, bonds, and always have some cash available on the side to deploy when quality stocks go on sale. It is also important to rebalance the portfolio as and when needed. For example, let's say you had $100 with you and you decided to buy stocks for $70 and keep the balance $30 in cash. Over the next 6 months, your stocks did really well and went up to $170. In this case, it is prudent to sell $30 of stock so that your portfolio returns to a balance of 70% stocks and 30% cash. It should be noted though that the rebalancing should be based on market conditions as well as the fundamentals of the assets you are holding. For instance, in a long bull market, it is desirable to stay more conservative when compared to a long bear market. Moving along, let's see how we can go about researching what assets we want to invest in. Fundamental analysis is a method of evaluating the value of an asset, for example a stock, by closely assessing the financial statements of the underlying business, researching about the future prospects of the company, and clearly understanding any risks that the business may be facing. There are several tools at our disposal to perform fundamental analysis. For stocks, we can gather most of the information we need from the company's website, where all the financial information and investor presentations will be available for free. We can also use financial websites like morningstar.com to gather this information. Another tool many investors use is technical analysis, which helps in looking into factors like where a particular stock is in relation to its average trading range over the long term and make calculated decisions about when to buy. It is very important that in the context of long-term investing, technical analysis should never be used to replace fundamental analysis, but certainly it would help a great deal when used as a complementary tool. When evaluating investment options, it is also very important to decide what is the long term rate of return you are expecting. Many North American investors look for stocks that is expected to return 4 or 5% because they feel that is approximately 2% better than the current risk free rate in North America. This is called relative investing. This logic looks great on paper, but as soon as the economic situation changes and the interest rate starts going up, then the stocks that was expected to only yield 4 or 5% will fall significantly. So instead of being a relative investor, it would be better to be an absolute investor and only buy quality investments when their prices are at levels where you can expect to get the absolute return you want. For example, 10% or 12%. It is certainly possible to find such opportunities if you have the patience and focus on improving your researching skills. Now let's talk about a few things to be careful about when researching investment opportunities. The first thing to keep in mind is to try and avoid following mainstream financial media as much as possible, as it is usually focused on the short term events which will not be of much value from a long term investing perspective. The next thing to not focus too much on is analyst recommendations, as their focus is also usually on the short term market cycles. It is also very important to be conscious of avoiding confirmation bias that most investors experience. For example, if a reputed analyst recommends to buy a stock, 5 other smaller analysts may also do the same, just blindly following the reputed analyst. Many investors assume this as 6 independent confirmations and will jump in to buy the stock without doing any additional research. When creating a long term portfolio, it is also very important to understand the impact that taxes and fees could have on your return. To reduce the impact of taxes, it is always better to build out the portfolio in tax free or tax deferred accounts. In the US, you could consider investing through an IRA, and in Canada, you could open a TFSA account or invest through an RRSP account. If you live in other countries, please do your research to find the ideal options or leave a comment below with your specific questions, and I can make another video to cover this topic. Talking about fees, the most important thing to consider is to use brokerage accounts that don't charge very high commissions for the trades you make, especially if you're investing very small amounts on a periodic basis. You should also be very careful of any hidden charges like monthly fees, management fees when investing in ETFs, unreasonable currency exchange fees, etc. Finally, I want to share my thoughts on the right mindset we should have when building a long term portfolio. In the current environment, it is very easy to get greedy as there has been a bull market where every asset class is just going up and up in the last 10 years and everything looks great. But this is the time to be very careful and evaluate each investment idea with a lot of care and caution. On the contrary, when the market starts trending down, it is only a question of time, but it will happen. Then it is time to become more greedy, as the majority of investors will be fearful in the situation. If we have this contrarian attitude, we will always do much better over the long term. And having an open mind to learn something new every day will do wonders. Thanks for your time. If you enjoyed this video, please click on the like button and subscribe to this channel. And please leave your comments and any questions below, and I look forward to talking to you in the next video.